Hi everyone, I'm Ubina Kapasi and I'm here to discuss what the fixed income market could look like in December 2023. For that, I have with me Abhishek Bisen, the head of fixed income with Kotak Mutual Fund. Abhishek, thanks so much for joining us. We tend to look a lot at what's happening in the United States as a guidance for the fixed income market, and the inflation reading softer than expected. Do you think that the latest reading could change how the US Fed is approaching interest rates, perhaps even impact the dot plot?
Incremental data is coming in much softer than what the market was anticipating, so which is a welcome news. However, we are living in a very uncertain times, and there are too many factors which are impacting the same. As far as the projections are concerned, which the markets are doing, we are in a fairly decelerating mode in terms of inflation. However, given the uncertainty and the factors which impact these data points, Fed would like to wait these projections to come into reality and then probably act upon the same, which probably will take, let's say, a quarter or so in the calendar year 24. Then probably we'll have much more clarity on the same.
All right. Okay. So wait and watch approach, essentially.
Yes.
Okay. Let's talk about back home. We're seeing a slew of IPOs really coming in. Do you see that sucking away the liquidity in the system?
Misnomer, I must say that IPOs suck out liquidity from the system. Okay. So it definitely skews it for the time being and impact equity markets, if at all it impact in a way, because let's say you have allocated X amount of money for to be invested into equity, and suddenly there are so many IPOs. Yeah. So you apply 100 rupees worth of money in an IPO, and let's say you get a 5 rupees or 10 rupee kind of allotment. Then the balance money comes back, then only it will act upon the equities. Yeah. So from that perspective, yes. But from fixed income perspective, the overall banking system liquidity remains neutral. Nothing happens to that. And short-term rates here and there, because of demand and supply, somebody may issue a short-term paper, etc. That may happen, but overall, no, nothing.
I like how you gave that allocation number, because yes, allocation is so difficult to get off late. Okay, let's talk about the trade deficit. I think the recent merchandise deficit number was on the highest monthly figure on record. Do you see this impacting the Indian rupee?
Yes, actually, the trade deficit is one of the key figures more than the fiscal the RBI is watching at this point in time, because they just can't take any chances on the currency front, because it makes the job much more complicated for the RBI, and they are playing in on the front foot in terms of intervention in the market, because we are, as I said, living in a volatile world. Yeah. Sometimes the flows are stronger because Indian economy is one of the best relative terms in the overall world. So they are actually keeping close vigil on the rupee and acting in both ways to manage to maintain the volatility in the real terms. So what happens is, if the global all the currencies are volatile, then probably RBI may leave a little bit. But if everywhere things are normal and the rupee is volatile, then it is an alarming thing, which the RBI would not tolerate at all, and they are managing it paisa by paisa. So by keeping liquidity tight, they are managing both fronts. The trade deficit also remain under control, and as a byproduct, you get inflation also under check.
You know, the RBI had spoken about OMOs, but they haven't actually conducted those operations yet. So how do you see that shape up? Do you think the RBI could actually go ahead and conduct a round of OMOs?
Yeah, so one rider they actually put in the previous policy when they announced this, they linked the OMOs with the liquidity.
Okay.
Now, what is happening is liquidity by itself is under reasonable deficit. Probably RBI is also managing the way they wanted, and it's not by chance. They are actually wanting it to keep much slightly tighter side rather than on the loose side, because tight liquidity has a much better impact on the overall inflationary front more than rates. So what they have done, they have actually infused one more rate hike by keeping liquidity tighter. They have not touched rates, but tightened liquidity, which took rates higher. So you have actually impacted the inflation much more harder, while keeping the overall economy safe. Because if you are aware, most of the loans are linked with the repo rate.
Yes.
If you touch the repo rate, unnecessarily, a lot of people get impacted, which are not the culprit. But incrementally, if you want to add, you tighten the liquidity and the incremental demand goes down. So that is what has happened. And since the liquidity is already tight, so OMOs will not be used in the near future as it appears. But yeah, some sales, etc., which doesn't impact much, is happening on the in the market by the RBI, but that doesn't impact the system as such.
So I think you've given me a good segue into the next question, and that's in the upcoming monetary policy meeting. Considering that the RBI is already using a series of other actions to essentially tame inflation and control liquidity, what do you think is going to be the decision on the repo rate?
So as I already said that they've already infused one more rate hike by keeping the liquidity tight, and given the overall uncertainties around the world, they are likely to remain. They're not likely to lower the guard sooner than what is needed. So on the rate front, nothing is needed given our inflation expectation for the remaining part of the year, and for the next year also we are very well. Positioned in terms of inflationary pressures. Liquidity is tight, rates are higher, real rates are positive. So nothing to be done from that perspective. Yes, from the forward guidance perspective, they probably may keep it a hawkish stance as they've been doing it so far. So no change. It's going to be on a similar lines for the upcoming policy.
Okay, so tighter liquidity, more or less stability in the interest rates. Given this, what would be your advice on how investors could, invest in debt mutual funds?
Yeah, so it's been some time we've been advising investors to up their duration of the investment portfolio, because we believe that from the tightening front, from rate hike front, RBI has done what is needed given our macroeconomic fundamentals. And if you observe, we have behaved much differently vis-a-vis the global world, because they had a different set of issues and we are in a much better shape. So we are done with hikes, and probably from here on we may plateau for some time, and then the cuts may begin in the next financial year, as and when the global situation is much more clearer. So given that perspective, we believe investors should up their duration portfolio or invest in actively managed duration funds as per their risk appetite. This is what our recommendation would be to the investors.
Tighter liquidity and a rough sketch of what interest rates could look like world over. Thank you so much, Abhishek, for joining us and sharing your thoughts on what investors could do with debt mutual funds.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.